Are you a business for self owner and you feel like you have to keep jumping through hoops to get your financing? Well, you probably do. And in today's video, we're going to discuss conventional financing, A financing, B financing, commercial financing, and how to get into a property using your business for self income. So stay tuned.
Hey guys, Aaron and Josh with the Findlay Mortgage team, and today we want to talk all things business for self. We're looking at A lender products, B lender products. We're talking about some multifamily stuff that you may not know about, and we're also going to talk about what happens if you own a business and you're looking to purchase a building for your own occupied unit. So stay tuned because we've got a lot of stuff coming up.
Yeah, guys, business for self is probably the best way to be financially free, especially in Canada. You know, the majority of multimillionaires that I know, they own their own businesses, they've been operating them, but there are tons of constraints when it comes to borrowing capital for a few reasons. One being nobody wants to pay the government any more taxes than they already do. So the challenge with it usually is that nobody claims enough money on their personal taxes to be able to qualify for a mortgage on the residential side. So we're going to get into today around the tips, tricks, and how to navigate getting financing. Let's get into it. So for residential real estate, an A lender, the basics, what do we look at? We look at 2 years, T1s, or T4, T5 income, inclining year over year. Now, most business for sale people who are just starting out or who aren't established don't pay themselves hundreds of thousands of dollars a year on their T4s or T5s, specifically because the amount of personal tax obligation that they have to have. So if you are an established business for self person and you do claim an okay amount or a significant amount of your personal taxes, usually what we'll do is we'll use a high net worth product. There's usually a ton of liquidity, either in savings, bonds, stocks, cash. And what we'll do is we'll use your T4 or T5 income year over year. We'll use a high net worth product to verify your liquid assets. And we can usually get up to about 60% TDS. And that'll allow us to get to 80% loan to value. So, you know, for the high net worth people who do claim on their taxes, this is probably the best way to go about qualifying for residential, owner occupied or rental properties.
Yeah, some of the other options out there on the A side. There are some lenders out there that will take a look at adding back a certain amount of your net income after tax left in your corporation. So, minus any sort of dividends, they take a look at somewhere between like 40 to 60%. It's an internal calculator. But again, if you keep a high amount of retained earnings in your corporation, this might be a really good option for you to help boost up your personal income that you're already showing on your T1s. Another option that's out there, and it's not really talked about because it is a pretty difficult product to qualify for, but there is business for self stated income products on the insured side. What we're really looking for here is someone that's had 20 years of history in IT, and now they've gone out and they've started up their own IT company. These insurers, they don't want you getting into the business for the first time when you're in your first year. They want substantial success, a good track record, and someone who's just decided to venture off now for the first time. We're able to look at this as a traditional type of product where we're looking at your business statements, putting together your gross income, deducting that business expenses, and qualifying you with that net amount. We can get pretty high here on the loan to value, but ideally you are putting about 15% down on this product. But again, even though the down payment's a little bit higher, we're looking at better interest rates, right? So we're trying to get you as cheap as loan as possible. But it's it's a good product if you can qualify for it.
Yeah, I personally use this product. I use the Sagan's product, their BFS Alt A product. If you're in business for over 2 years with this product, same thing as Aaron said, it makes sense to put 15% down, but the minimum you have to put down is 10%. The reason why we say that is because the insurance premium is significantly higher, and if you can't afford to put down more capital, it makes sense to do it just due to the cost of the debt. But all in all, it's more like a declared income product. It has to make sense with the industry that you're in, so you can't just claim $1 million if the average industry income is like $250,000. So they ask you a few questions like how many employees do you have? What was your total income last year? What declared income you want to make? And they will ask you for your bank statements just to verify, there is some consistency here. But it allows somebody who doesn't claim hundreds of thousands of dollars in their taxes to be able to get the absolute best financing possible. Now, keep in mind, you're kind of pigeonholing yourself into one lender moving forward, specifically because that insured rate, you're not going to refinance out because you're not going to have enough money or claim enough money to refinance on the A side unless you start to use these high net worth products after the term of your loan is done. So just keep that in mind. But all in all, if you are a successful business for self owner and you do have over 2 years or under 2 years experience, depending on the situation, there are great products for you in the market.
Yeah. Next up, alternative lenders. So these are going to be our B banks. Biggest misconception here is that these guys aren't really banks. But if you take a look at the top two, Home Trust and Equitable, Home Trust. These are Schedule 1 banks, guys. These are the same Schedule banks that you're going to TD, to RBC, to BMO. They are Schedule 1 institutional lenders. So, don't be afraid to use these guys. These guys have really great products across the board, not just for business for self guys, but a huge product suite. But specific to the business for self, we're looking at a 12-month bank statement program. So again, 12 months business bank statements. We're going to calculate your gross income and deduct usually your top 5 business expenses. The banks do see your business bank statement. So again, if there's transactions that are showing up repeatedly month over month over month and you don't include those in that top 5 expenses, they are going to see that, they are going to ask. So, we do have to do due diligence here and we can't just make up numbers. They are going to see the actual track record. But, it's a great product. Some other benefits, we're using much higher TDS ratios. On some of these lenders, you can get up to 60%. You can get, 35-year amortizations, extended amortizations to be able to help reduce, that monthly cost. Some flexibility in terms of down payment. You can borrow from your credit cards and your lines of credits. The flexibility of these B lenders, they're great for business for self guys. Some of them do have net worth programs. They're taking a look at, maybe if you have 25% of the loan, 50% of the loan, you can get some extensions on your TDS, moving around your amortization. Flexibility there in terms of your qualifying structure. But overall, I kind of can't say enough about these B products. They're great products. Is there a fee? Yes. There's some fees on the B side, but in terms of what you're getting and what it allows you to do and the access to the product, it's huge.
Yeah, usually what we'll do is we'll just do a cost benefit analysis. Let's say you got to claim $250,000 a year for the next 2 years to be able to qualify for your home. How much tax are you paying the government year over year to be able to make that happen versus, what is the total cost of actually acquiring your loan with an alternative lender, just showing your bank statements? It doesn't make sense just to go that route for a slightly higher increase in your premium. Realistically, you're about 50 basis points higher on an owner-occupied side. If you have good credit, they tier their pricing based off of credit. So if you're just not showing enough income to qualify, there, again, as Ehren said, phenomenal products. Just understanding the total cost of it and how it works is the most important thing. You can take shorter terms. They usually offer a 1 year, 2 year, 3 year term. So you can have longer term to be able to reduce overall rate risk in the current environment we're in as well. So each lender has their own specific niche, and some of them are really good at certain things. Some of them are specifically made to focus on business for self borrowers. So just keep that in mind when you're looking for a mortgage.
Yeah, and the cost benefit analysis is actually a good point, because I've had this conversation with investors where if you're buying one property per year and you're going to take a look at, what does it cost yourself to pay taxes on 2 years to be able to qualify with an A lender, versus if you're, a retail investor and you're looking to buy, 5, 6 properties or whatever that is, you got to understand, what do the fee structure look like on buying 5 or 6 properties per year versus how much you're going to spend on taxes in that 1 year. If you're getting 5 properties at $5,000 a fee, and you're spending $25,000 or maybe $50,000 because you're gonna have a broker and a lender, are your taxes going to be under $50,000 or going to be over $50,000? So it is an important thing to keep in mind. It's how many properties you're going to be buying, and does it make sense to pay the taxes and just qualify with an A lender and save, or does it make more sense to just qualify with a B lender? So it's a good point.
Yeah, all the math, determining exactly what your financing structure is going to be and what your plan is moving forward. If you're buying again one property, as Ehren said, it might make sense just to go with the B lender. You're going to buy 5 or 10 and you have ambitious means to scale, then take a look at the numbers, and does it make sense? At the end of the day, it's all a numbers game, especially when you're investing. For all of our business for self borrowers out there are some really cool products that are actually coming out with mortgage investment corporations. So let's say, for example, you're in a situation, A, financing didn't work, B, financing didn't work, and you need to qualify with alternative financing. Now, there are some declared products out there which essentially just require an attestation form. Depending on the lender, you're between 65 to 70% loan to value, and these lenders allow you to be able to write down essentially what you would make, and that is the income verification that they're allowing you to take on. Now, some lenders that we work with are offering as low as 7.99%. They do have about a 3% lender fee, but they can't offer multi-year terms. So, there are phenomenal options in the market for short-term financing options available. Now, long-term financing, you want to make sure that this is going to work for you. Now, this might just be a stepping stone if you need to fix credit or be able to claim more income, or you need to have, show more retained earnings in your corporation. This is like a short-term option for 1 or 2 years to allow you to be able to structure your finances properly to transition out of this type of financing into more long-term financing options. And for all those multifamily real estate investors out there, we have kind of a hack with one of our SKA lenders that this lender allows you to actually use some of the retained earnings in your corporation after taxes to be able to service a multifamily building. Yes, you heard it right, a multifamily building. So if you are purchasing a multifamily building and your active business is going to have a unit in this building, what we can do is we'll take the current debt servicing on the building, and then any sort of shortfall to be able to meet the debt servicing requirements, they'll actually let us use the income after taxes to be able to add it to the gross income to service that debt. It is a pretty niche product, and it is specifically made for people who are looking to put their companies in these buildings. So if you have a mixed-use building, this is a great option to be able to get in without having to take on the expensive cost of private acquisition financing.
Yeah, and just to clarify with this, we're really looking more for a satellite office. So if you're an Ontario investor and you have, you're looking to expand in BC or Alberta or something like that, and you want to buy an apartment building and use one of those units as your satellite office to help expand, this is the situation that we're talking about. We're not just talking about someone who lives in Ontario and you're looking to buy a building in your own city. That's not going to classify. So it's got to be, there's got to be a remote aspect to it and some sort of business strategy around it. But again, a really cool product if you're looking to kind of expand and you need a little satellite office. Really cool product.
Talking about cool products, commercial owner-occupied loans are becoming a hot thing. So if you guys are looking to get into a commercial unit, there are a few different lenders out there that offer specific financing for owner-operators, people who are looking to acquire a property and to qualify for the loan.
Yeah. Obviously, a big part of owning a business is wanting your own space. Sometimes you don't want to rent forever. Maybe you want to build your own building, or maybe you want to buy a unit. We have commercial lenders that will give you pretty competitive loan to values. If you have a strong enough company, I've heard of 100%. Heard of 110% sometimes. If you're a mega company, you got really high financials, they're really flexible. They're going to take a look at what kind of business is it, how safeguarded are you against economical and environmental changes, the whole thing, right? They're going to do their due diligence. But the point is here, if you're looking to expand your business and you have strong enough financials, the products are there. The flexibility is there and the creativity is there with these lenders to be able to help get you in for pretty minimal cost depending on the file.
Yeah, and the really important part here is that your financials need to be strong. When we're looking at taking on an industrial building or a commercial type building, the lenders are looking at your total net income. So if you have massive millions of dollars in gross income, but you depreciate everything and write everything down to zero and you have negative earnings because you're not paying any taxes, that's not going to fly with companies like BDC or some of these larger lenders who are giving you loans. You have to, unfortunately, bite the bullet to show the retained earnings and to show the income on paper to be able to actually get these loans. They are top tier loans, so just ensure that, and I know from a financial perspective it makes sense to not pay taxes when you're in growth mode, but you can't have your cake and eat it too in this situation. Something to keep in mind is when you're looking to purchase an industrial building too, we as brokers, but as the underwriters from these banks, they also take a look at two ways to underwrite a building. They're going to look at your ability and your business's ability to service the debt, so the mortgage on the property, but they're also going to look at a stabilized debt servicing as well. So they're going to look at the fair market rent per square foot and how does the building operate if they had to take it over. So not only because it's great that your business can pay for the actual mortgage, but if they had to take over the property and have somebody rent out the property, how does it service? And unfortunately, when you're buying properties in Mississauga, the GTA, and the cost cost of the land is so high, the normalized underwritten value of these buildings unfortunately doesn't service at the same level as your ability to service the loan. So just keep in mind that your loan to values in like major areas like the GTA can be drastically reduced depending on what you're looking to buy.
Yeah, I think an important like kind of note that keeps popping up here is how you do your taxes and what your game plan is moving forwards. You know, in general in real estate, you typically have like your three pillars of professionals that you're dealing with on an ongoing basis. You have your lawyer, your accountant, and your mortgage guy. All three of us are probably going to give you some sort of different idea and structuring of how you should handle your financing or legal structures. At the end of the day, it really does come down to how you qualify for the mortgage. It's great if you can save as much money as you can on taxes, but if you don't show any income on your personal or your business side, it's going to make it really difficult for you to acquire assets. It's going to put you into more private and alternative type investments. So, if you're thinking of making purchases moving forwards, either rental properties or your primary home or an office building, industrial building for your business, approach us first. Let's sit down and figure out how are we going to qualify, what does that look like, and what do you need to show, and then go back to your tax guy and your lawyer and structure it appropriately. And it's it's nothing against these other professions. It's just at the end of the day, we have to be able to give the lenders what they want to see on paper. So it's an important conversation to have ahead of time. And again, just going into having a game plan, not just kind of jumping into something and thinking, well, I've made a lot of money over the last 3 years. I should be able to buy whatever I want to buy. Again, it's what can you show on paper?
Yeah. The name of the game, those who have the goal make the rules. So if you're looking to get into this and you want the best top tier financing possible, again, as Ehren said, come and talk to us. We'll let you know what at least the lenders want to see, and then we can set expectations as to what type of financing you can get based off your property and your financials. If you guys like this video today, we really appreciate it if you hit the subscribe button, hit the like button. It allows Ehren and myself to shoot more content like this for you every single week. So if you have any questions, feel free to reach out. The contact information below. Ehren and I really love making these videos for you. So until next time, appreciate it, guys.